I'm Marty Prince, and you're watching Ask a Mortgage Broker. Hello, I'm Marty Prince, and I've been a mortgage broker for over 30 years. I've helped hundreds of people either buy or refinance their homes, and I started this web series to answer your questions about the mortgage industry. So our question today was emailed to us by Tom and Danielle from Pasadena, and they write, "We own our home and we'll be selling it and buying a newer, bigger home. We've heard that borrowing is a lot harder today than it was 5 or 10 years ago. What should we expect?" This is a good question. I would say borrowing is the same process it's been for the last 30 years. Yes, however, there are some complex things that have entered in over the last 5 or 10 years. What happened was, we all remember that in approximately 2006, 7, that time period, 2008, there was a kind of a collapse in the mortgage industry, and people had overextended themselves. They had borrowed more than they should have. The mortgage lending industry had gotten out of control, and people were buying homes with low credit scores, no down payment, and no documentation. So it was a recipe for a disaster, and the disaster happened. Unfortunately, what happened was the government now entered in and decided they were going to regulate the mortgage industry. That's a good idea. That part was good. So they got rid of all the types of loans that didn't need to be there. They got rid of the subprime loans. They got rid of loans where you didn't have to qualify. Those loans are gone. Now, as soon as they accomplished that, things were great. But they then took it several steps past that point. And what happens now is it's the same process that you go through, but now the documentation and the amount of double and triple checking information has basically increased. So now what used to be a set of documents that you signed were, maybe 5, 10 pieces of paper, are literally now an inch and a half thick when you sign your final loan documents. So the process is the same, to answer your question. What's different is the amount that you're going to be expected to jump through hoops to get your financing. So let me now give you some tips on how we can make that as painless as possible. The main steps that you have to document are your ability to repay the loan, your credit, and the collateral that's used to get the loan. The collateral is a fancy word. That's simple. Your house is what you're pledging on the loan to say, if I'm not able to make this payment, the lender has the right to use the house, take the house, and pay off your debt. We don't want that to happen, but that's what collateral means. Your credit, obviously, is your history of making payments, whether timely, not timely. Are you overextended? Do you have a history or a pattern of not making payments, or are you great? So that's credit. The character or capacity part has to do with your employment, your stability as an employee. Are you self-employed or are you not self-employed? Self-employed people are looked at a little differently. So that's the character part of it. What's changed in lending that's gotten stricter is this. As a self-employed person, you are going to be expected to prove that you're self-employed by tax returns. Then they're going to go another step and ask you to have your CPA say that you're self-employed. You probably have to produce letters and documentation. So again, same process, but just be prepared that you're going to be asked to go over that territory several times and prove that you are capable and you are able and you are self-employed, but you're stable and you can make the payments. Okay. Things not to do during the loan process. Maybe this will help a little bit. Once the loan process starts, what you don't want to do is now take on any new obligations. You don't want to go out and buy a new car without somebody knowing about it. You don't want to open up new credit cards. That's not a good idea. You don't want to change the type of employment. Some people I've seen, maybe their salary is $6,000 a month, and the employer now says, okay, we can put you on a bonus system where we'll reduce your salary down to $2,000, but you have the capacity to make $10,000 a month with a bonus. It sounds great, but the lender now looks at that and says, well, we don't really know what your bonus is going to be over the next several years. So even though it's a good opportunity for you, it's not something that's good for the lender. So in other words, don't make any major changes once that process starts. So just to kind of recap, you can expect the same process you had last time, except more paperwork, more questions, and a little more time involved in the process, and same result, but more work on your part. We try to make that as simple as possible, but be prepared for those kind of things to happen. And I hope that answers your question. If you or someone you know has a question regarding anything in the mortgage industry, email it to mprince@socal.rr.com, or you can send it to us via our Facebook page so we can feature it in a future episode. Be sure to give us a thumbs up and subscribe if you like what you saw. And as always, thanks for watching.